Okay. So let's go over, we're on number 4 on the practice. We did the first 3 on Tuesday. So we're on number 4, and again, we're dealing with financing activities. So it says reporting stockholder equity items, okay? So here we're seeing common stock and the paid-in capital in excess of par common stock. And it says, you know, what do we need to report on our statement of cash flows? There were no unpaid dividends at either the beginning or the end of the year. So dividends payable doesn't have a balance. That makes life easier. And we see we have common stock, paid-in capital in excess of par common stock. And then on our retained earnings, it clearly shows the cash dividend that we declared, okay? And they're saying there was no balance in dividends payable, so that tells us that we paid that entire cash dividend, okay? So the first one that we'll look at is it says we want to look at the sale of common stock. Well, again, these are all financing activities. So the section it belongs on is the financing activities section. When I sell common stock, does that increase or decrease my cash? Increase. Good. We're getting money, right? And how much money did I get when I sold on April 2nd? We sold 30,000 shares, bless you, of common stock. How much total cash did I receive? We did receive 1.2 million for the par amount. Is that the total amount of cash, though, that we received? Yes, yeah, so we need to look at both, right? We have 2 entries here. We have the 30,000 shares, 1.2 million, that's the par value. And then we also need to add in the paid-in capital in excess of par. So that's the same entry there. So all total, we have 1,920,000. We usually actually with common stock, we won't deal with that, at least in here. So it'll always be at par or in excess of par. So you would, if we sold it at par, we just wouldn't have anything here. And we would just log the 1.2 million. Yeah.
And so on the stock dividend,
yeah, the stock dividend we don't deal with at all. We'll disclose that like in our non-cash investing and financing report. And that's a good example of something that would go on that report. So we have sale of common stock, goes on financing. It's added, it's a cash inflow. And we determined it was 1,920,000. 1,920,000. And then it asks about the cash dividend. Well, again, it told us there was no balance in dividends payable. So we paid out this full cash dividend of 315,000. Well, again, that goes on financing activities. When we pay a cash dividend, is that adding or decreasing our cash? Very good. It's decreasing or deducted. And I like to put them in, I think it even asks us to usually, it's a minus 315,000. Okay. Since it's being subtracted out, minus 315,000. And then our stock dividend, did any cash, we kind of already talked about this, right? Stock dividend, did any cash increase or decrease? No. Okay. So that one's actually going to be not reported on the statement of cash flows. Okay. And so it's basically neither added nor deducted, and there's 0 amount to deal with. Okay. Any questions on that one? So again, that dividend example was pretty easy. We didn't have to worry about what was in dividends payable. Okay. See. Okay, this one we're looking at land that has a mortgage note on it. So basically what it's showing us here is we had land that had a beginning balance of $156,000. On February 10th, we purchased land for cash, $246,000. On November 20th, we purchased land with a long-term mortgage note. So those are the two transactions we're analyzing. Okay. Well, if I purchase land, is that operating, investing, or financing? Investing, good. So that's an investing activity because we're purchasing a fixed asset. Added or deducted? Deducted, good. And then we can just go off the amount, right? The 246,000. So minus 246,000. Very good. What about the purchase of land by issuing long-term mortgage note?
Schedule separate?
Yeah,
Separate schedule.
very good. It's on a separate schedule, right? Because there was no cash received or cash paid. But it is still an investing activity. It's a non-cash investing activity. So that's going to go on the separate schedule that lists non-cash investing and financing activities. And again, it's just going to be reported only. So it'd just be the 324,000. So you don't put that one in as a negative just because it's reported only. So we don't show it as an increase or a decrease there. Any questions on that one? Okay. On to the next one. The next one, as you can see, is dealing with bonds. Okay. So here we want to analyze what's going on in the bonds payable and on the discount on bonds payable. So when I look at my bonds payable, it had a beginning balance of $750,000. On January 2nd, we retired bonds, meaning we paid off their face value of $150,000. And then on June 30th, we issued bonds for $450,000. Well, we also have a discount on bonds payable that we need to look at. So our discount on bonds payable had a beginning balance of $33,750. On January 2nd, we retired bonds, these bonds here, the $150,000, and we credited discount on bonds payable $12,000. On June 30th, when we issued bonds, it was obviously for a discount because we debited discount on bonds payable $30,000. Okay, so we actually issued bonds at a discount. And then we have an amortized discount amount on December 31st of $26.25 on those bonds that we issued. Okay, so we have to look at this one a little bit more in depth, trying to figure out the cash amount. Okay, so we need both of these accounts to kind of figure out. So the first one we're going to look at is when we retired bonds. Well, on January 2nd, we retired bonds. The bonds payable, the face value was $150,000, but we had a credit to our discount on bonds payable of $12,000. So that probably meant that, this bond got called early or something. We still had a discount on it. So in this case, we need to subtract to figure out the cash amount. Okay. So we have a debit to retire bonds of $150,000 and a discount on bonds payable $12,000 credit. So all total, that tells me I paid $138,000 in cash to retire these bonds. Okay. So on your bond, just make sure you consider the discount amount. So which section of the statement of cash flows would retiring bonds go on? Financing, good. And when we retire bonds, are we adding or deducting? Deducting, good. And then I already told you the amount, right? The minus 138,000. Minus 138,000. And then issuing the bonds, well, we issued the bonds at $450,000, but they had a discount on them. So did we get $450,000 in cash? No. We would have to subtract. How much cash did we receive? Very good, $420,000. So when we issued the bonds, still a financing activity, but are we adding or subtracting? Adding, good. And it's the 450 minus the 30, or 420,000. 420,000. And the last item is the amortization of the discount. Where do we see amortization expense? What section?
Operating activities.
Very good. In the operating activities. We're using the indirect method. So if you remember, the operating section is where we deal with the discount, the amortization. So when we're doing our operating activities, we start with net income. We add back in depreciation and any amortization expense. So that's the 2625. And it gets added. I think I just said that, right? So it gets added in to the net income since it's a non-cash expense. Okay. Any questions on that one? Okay. On to the last one, which is our fun long one. So in this case, we are going to look at all of the comparative balance sheets and extra information that they provide us, and we are going to prepare the entire statement of cash flows using the indirect method. Okay, so kind of right back on the board, the indirect operating activities. Okay. So for just the operating activity section, we know we're using the indirect method. So we went over all this on Tuesday and talked about it and did examples. You know, we start with net income. We add in depreciation and or amortization. We subtract out gains. We add in losses. We subtract out increases in current assets. We add in decreases in current assets. We add increases in current liabilities, and then we subtract out decreases in current liabilities. That all added together will give us our net cash flow provided if it's positive, or used if it's negative, by operating activities. Okay, so that's the whole operating activity section. Again, this is the indirect method. We only have to worry about the indirect method when we're dealing with the operating activity section. Okay. You guys shouldn't tell me I could have been late. So what we're going to look at is we're going to look at our comparative balance sheet to kind of analyze what's going on. This tells us of a lot of things. Well, when I first look at this, I see cash. I see, you know, the first year was 14. I'm assuming this is probably in thousands or millions and not actually $14 in cash, right? It doesn't say, but most of the time it's in at least thousands, if not millions. $14 though. And then at the end of the current year, we've seen an increase in cash, so we now have $183. And then we have, our current assets, accounts receivable, and inventories, fixed assets, land, and equipment. We see our depreciation there. Liabilities and stockholders' equity. We only have, accounts payable is our only current liability we deal with. We do have a dividends payable balance of 5, so we'll need to consider that. Common stock has increased as well as paid in capital, and we've seen an increase in retained earnings. So here, instead of giving us all of the ledger account information, they've just given us some extra information to prepare the statement of cash flows. They told us, land was sold for $120. Equipment was acquired for cash. There were no disposals of equipment during the year. Okay. Common stock was issued for cash. There was a $62 credit to retained earnings for net income. So there's our net income amount, since they also did not provide us with the income statement. And they said there was a $24 debit to retained earnings for cash dividends declared. Okay. So we need to look at all of this information and determine where this goes and how we do it on our cash flow statement. Okay. Well, again, we're going to start with the operating activities section. And since they didn't give us an income statement, they did tell us, though, there was a $62 credit for net income. So that's my net income amount, $62. And then, again, they didn't really tell me, they didn't give us an income statement, so we have to figure out what our depreciation expense for the year was. So when I'm looking at the comparative balance sheet, though, I can calculate that. Okay, accumulated depreciation went from 42 to 68. So obviously we had an increase in depreciation expense. Okay, so what is that, 26? So our depreciation for the year was $26. So that's how I would calculate that. So we're going to add in depreciation of 26. Do it. You good? Oh, okay. Yeah. This one, I wish they would have just given us an income statement because it's easier to analyze everything. But yeah, they did give us the net income here in Part E on this one. So it's just a little different approach. There's different ways we can get this information. Okay. So depreciation was $26. I would look for, they didn't say anything about any amortization expense, and I don't see anything here. So we're good there. So I've dealt with that one. Now I would look for any losses or gains on the sale of fixed assets. Let's see. Well, we sold land. They told us that. They told us that land was sold for $120. So I would come up here and I would look at, well, how did my land account change? Well, land was $330 and now it's $250. So how much did land decrease? $80. Very good. Land decreased $80. So my land account, the land that I sold was worth $80, and it tells me I sold it for $120. So did I have a gain or a loss on that sale? A gain, yeah, a gain of 40. Very good. I sold land that was valued at $80. I sold for $120. Okay. So again, when I'm looking at that, I would look at, what happened in my fixed assets? Did I have any gains or losses? Well, I sold land for $120, but the land account only went down $80. That means that the land was valued at $80. Okay, so I look at the land change, the change in the land, to calculate the value of the land. So it was $80, and I sold it for $120. Well, that means I had a gain on the sale of the land. So I'm going to subtract it out, because we subtract out gains. Yes, yeah, what I would look at is they're not giving me like the ledger accounts, but I can kind of recreate it, right? So if I actually had a land like T account, for instance, I had originally purchased land at $330, and the imbalance was $250. So that would mean I sold it, the value of the land that I sold was $80, okay? So that's really what it's showing me. My beginning was $330, my ending was $250, so I subtract, and that was the sale of the land, the value of it. That's what we originally paid, okay? That was sold. And so to figure out my gain or loss, I would just look at that I actually sold it for 120. Okay.
So what is like the value of the land? Oh.
You good then? Maybe.
You're just using the 250.
Yeah, because we started, the land had a beginning balance of 330 and it went down to 250. So I just figured that tells me that the land that I sold had an 80 value. Yeah. So really you're just subtracting to figure out the value of the land. Okay. Any other questions on that one? Okay. So there we have net income, add in depreciation, subtract out the gain on the sale of land. We didn't actually sell any other long-term asset, so we don't have any gain or loss outside of that. So we're done to here. So now we just need to analyze our change in current assets and current liabilities, okay? So I would come up to my comparative balance sheet, and the first one I'd look at is accounts receivable. Did it increase or decrease? It increased, good, by what, 6? So we have an increase in a current asset, so I'm going to subtract it out. Do it. So we have an increase in accounts receivable. We're going to subtract it out. Increases in current assets get subtracted out. My only other current asset is inventory. Did it increase or decrease? It increased as well, good, by what, 18. So inventory's also increased. Bless you. So we have an increase of inventory, so minus 18 there. So an increase in a current asset gets subtracted out. And then last but not least, we have only one current liability. They made this one a little short, right? So accounts payable is our only current liability. And did it increase or decrease? It increased as well. And it increased what, $14. So we have an increase in accounts payable. So it's an increase in a current liability. So I'm going to add it. Increase in current liability gets added in. Okay, so then I just need to take net income plus depreciation minus gain on sale of land minus my 2 increases, add in my increase in accounts payable. So what is my net cash flow from operating activities? 38, very good. 38. Okay, so that completes the long operating section. And then we just need to use the additional information they gave us as well as the comparative balance sheets to figure out what investing activities took place. So again, investing activities basically dealing with long-term assets. So when I look at this, what investing activities do you see? Did we buy or sell any long-term assets? Yes, no, maybe? Not sure.
Land.
Yeah, very good. We bought land, right? It told us we sold land. We sold land for 120. Okay, we've already recognized the gain on that. So what do I recognize on my investing activities? Well, is that increasing or decreasing cash? Increasing, good. So I have cash received from the sale of land. And how much was that? 120, good. Remember when you're doing your investing and your financing section, you aren't worried about what the value of the land was or the gain. You're truly just wanting to put the cash that we received or paid. Okay? So we received cash from the sale of the land, $120. Any other? Obviously, there's another one, right? Because there's a place for it. So what's our other investing activity? We bought equipment. Good. Now down here, it just tells me equipment was acquired for cash. So I would need to actually look at my equipment account up here, my comparative balance sheet. How much did we pay for that equipment? 30. Good. So that is being here. We had 175 at the beginning of the year, and that increased to 205. So that means the equipment that we purchased was for $30. Yep. So cash paid for purchase of equipment minus $30. Now, again, we know that that's the true cash amount we paid because they didn't tell us if there was a loss or a gain. You know, we just purchased it. So there's no gain or loss when we purchase something. So when you're dealing with the purchase of a fixed asset, you can just look at the difference in the account balances. Okay. So what is my net cash flow from investing activities? 90. Good. That one's pretty easy, right? 120 minus 30. And that's a positive as well. So we actually, the sale of the land made us have a positive net cash flow from investing. And then our last section is financing. Well, let's see. We've actually dealt with, you know, land, equipment. There were no disposals. So now we're down to Part D. It told us the common stock was issued for cash. So obviously we issued common stock, which is a financing activity. So what two accounts would I need to look at to calculate how much cash I received for my common stock? How would I calculate what I received for my common stock? Do what now? You said common stock? Very good. Yeah, I would need to look at both of these, right? Notice I have an increase in my common stock, the par value, plus an increase in the paid-in capital. So to figure out how much cash I received from issuing stock, I would look at the increase in both of those accounts. Okay, so the par value of the common stock I issued was what, $45? But I paid in capital, I got 15 above par. Okay, so 145, or no, sorry, not 145, 45 for the common stock, the par value, and then another 15 in excess of par. So all total, that means I received $60 from the cash, or $60 cash from the sale of common stock. So cash received from sale of common stock, $60. So when you're dealing with stock, make sure you look at both the common stock par value and the paid-in capital. Okay. This one didn't mention anything about bonds. We didn't purchase any treasury stock. So the only other financing activity that we have is Part F. So there was a $24 debit to retained earnings for cash dividends declared. Well, that's the amount of dividends we declared. That's not telling us the full amount of cash we paid. So with dividends, again, I would look at two things. I would look at my dividends declared, and then I need to look at this dividends payable. Dividends payable has a balance of 5. That means I still owe $5 in dividends. So if I declared 24, did I pay 24? No. I need to subtract. I need to take the 24 that I declared minus the 5 that I still owe. Okay? So I actually paid, what, 19 in cash dividends. So cash paid for dividends is a minus 19. Minus 19. So then cash flows from financing, 60 minus 19, or 41. get my total, the next one will be change in cash. So to get my total change in cash, I add up operating activities, investing activities, and financing activities. So 38 plus 90 plus 41. They're all in this second column here. And the change in cash is 169. 169. Well, I get my cash at the beginning of the year from the balance sheet. So up here, my beginning cash was 14. So I add in that 14 to get 183. Okay. So then I can double check. I can look up here. I started with 14, I ended with 183. That 183 matches what I got on my statement of cash flows. Does that mean I could have put something in the wrong section? Technically, but I do have all the cash inflows and outflows. Okay, so it's a nice little checkpoint. Okay. Any questions on that?
How did you get the change in cash?
I just added up the 38 plus the 90 plus the 41, so all three sections.
So the cash at the end of the year should
Uh-huh. Yep. Yeah, my cash at the end of the year, the 183 matches what the balance sheet shows. So it's kind of a reconciling process, really. You're reconciling the cash account to make sure it all matches up. And then there's just a couple of questions. It says, was Olson Jones net cash flow from operations more or less than net income? It was less, right? And that would be pretty common. I don't think there's any case that it wouldn't be that way. Unless you had really a lot of depreciation and not very many, non-cash expenses. So the net income was 62 and the operating activities was 38. So it's less. And it says, well, what are the source of the difference? And it could be more than one. Well, did the gain on the sale of the land affect our operating section? Yes. So we know it's A. What about purchase of equipment? No, that was in the investing. Sale of common stock? No, that was in financing. Changes in current assets and liabilities? Absolutely. So A and D. Depreciation? Yep, we added that back in. So ADE, what about dividends paid? No. So A, D, and E, the gain on the sale of the land, changes in current assets and liabilities, and depreciation, all affected the net income. Those are all non-cash adjustments that we have to adjust out of net income. Any questions on anything really in chapter 13? Okay. Yeah, we can look at it.